Hey everybody, welcome. How many folks partook of the Ben & Jerry's ice cream? Oh my God, all right, good. Sorry for those of you who didn't know about it. I just ruined your day. So sorry. We didn't get any up in here either, so sorry about that. And I think the window is closed, so we're not competing with that, which is good. Great to see you all. I'm Jim Matheson, fifth-year faculty member at Harvard Business School. And I want to thank my Harvard colleagues, especially my Slot Institute colleagues, and the Business and Environment Initiative colleagues in the back for putting together an amazing week of conversations. It's been really eye-opening for me to really deconstruct a topic I think I know pretty well, which is climate change and the challenges and opportunities of climate. But to see all of the different dimensions sort of and the complexity of it all is eye-opening. So I have learned a lot, and I'm looking forward to learning a lot with my friends and colleagues on the panel. So one of the common things that I've heard for the last couple of days, and I hear in every climate gathering, is the question about where does one garner hope in all of this reality? And a common answer to that question is innovation. Technology will save us. And as a technologist and an entrepreneur and investor in climate technologies for 25 years, I love hearing that because that's my avocation. On the other hand, having done this stuff for 25 years, I also appreciate just how hard it is to go from science to company to proof of concept, and then eventually at some point scaling these solutions to the size of the problem to make the impact and the financial returns that we need to make to really have a difference in the world. So the conversation I'm gonna have with my friends up here over the next hour is just that. So I hope at the end of the hour you come away with three things. First, you get a sense of kind of really where are we with these hundreds of millions of dollars of venture capital that have been invested and deployed. Where are we in the state of innovation? And where is that innovation on its way to what I call deployment and scale? So what's really happening? Let's ground in the reality of the situation. Second is what are the challenges, flip side, opportunities of actually getting across what I call the Grand Canyon of death. You hear about valleys of death, of financing and frictions that make startups difficult. But this move from innovation to deployment is really, as Mario and I have talked many times, the Grand Canyon of death. So what are the challenges and opportunities of getting across that? And then ultimately, what you'll hear is, and I'm so excited to have these three with me up here on the panel, is because they represent three sort of best-in-class, built-for-purpose organizations that are focused on this very challenge. So we are focused on financing mechanisms to bring these exciting innovations, these technology-based innovations, across that Grand Canyon of death scale so we can actually start to mitigate, and hopefully we'll also talk about adaptation for climate change. So that's our mission over the next hour. So I'll ask some questions for a bit, and with about 20 minutes left, I'm gonna come to you all for questions as well. So it's gonna go fast. So let's dive in. We're going to start with Mario and then Lee and then Jonah. What I'd love you to do is just quickly introduce yourself, but with a focus on your organization's mission. And you're all representing really interesting, as I said, built-for-purpose organizations. So talk a little bit about that, and in those introductions, we'll get a sense a little bit of the challenge and the opportunity, and then we'll sort of deconstruct all that together. So Mario, please kick us off.
Sure. Thanks, Jim, for the invite,
you.
and thanks for having me. So breakthrough energy, everyone has heard about breakthrough energy. It's basically, three buckets of effort. One is the discovery phase, which we do through our incubator called Fellows. The development phase is being done by Breakthrough Energy Ventures, a $3 to $4 billion venture firm that has invested in over 120 companies. And then the last phase is deployment, right, where both Catalyst, which I head, and now a new fund named Select, are able to sort of push this, take technologies that are ready to be deployed and help that deployment along. So as head of Catalyst, my job is to lead a team of infrastructure investors. So, we created a team of people that had been, at the largest infrastructure investors, to be able to really take the technologies that are ready to build a project out of them and, shape them in a way, shape that project contractually, structurally speaking, in a way that it could be attractive to infrastructure investors. Perhaps not on the first of a kind, but the second, the third. We want to set up replicable long-term structures that are profitable. I think that's a big thing for us, because if it's not profitable, people are just not going to invest money in it. But again, that infrastructure investors, which, as you know, lowest cost of capital and the largest sort of, billions of dollars in money, can go in and take a view on it. So that's what we do, and that is what we're trying to do.
Got it. And just full disclosure, I'm a partner at Breakthrough Energy Ventures and part of the Select Fund, although Mario will be speaking of that today. Lee, so tell us a bit about Trellis Climate, which is really the coming together of a couple of really innovative organizations. So tell us a little bit about the origin story and kind of where you are right now.
Amazing. Yeah. So Trellis Climate is a new initiative of Prime Coalition. So Prime is based here in Boston, and you might have heard of a couple of the initiatives they've launched in the past. So Azola Ventures is really doing the seed and Series A work to get climate innovation from lab out into the market. And Trellis is then going to address the next phase. So actually scaling those hard tech companies and helping them to do their first of a kind plants and facilities. So that can be an incredibly challenging period of time to fundraise for many different reasons we're going to get into here in a little bit. So Trellis helps to bring together philanthropic capital to create catalytic solutions to finance those projects. So we're very much in the launch phase right now and really enjoying bringing together the philanthropists and companies and other investors in this space and hoping to teach out some of our learnings in the coming months and years.
Got it. Thanks, Lee. We'll dig into that more. So, Jonah, from the government, thank you. You're here to help.
Here to help. I'm here representing the Loan Programs Office at the Department of Energy. We provide loans and loan guarantees for early stage climate and clean energy projects. We do a lot of other things, but for the purpose of today's conversation, the mandate I think we'll be talking about is the optimistic version, our optimistic version of the chasm of death, which is the bridge to bankability, which we talk about a lot, which is the process by which a emerging climate or clean energy technology goes from being something that, a handful of very aspirational and inspired, extraordinary innovators have cooked up somewhere in America to do amazing things to something that a bank will actually underwrite 100 times or 1,000 times and bring to scale in a way that it actually makes a real mark on the climate. And just to put a few things in perspective, we currently have about $290 billion worth of loan applications in our pipeline, representing about $500 billion of projects. We're on track to do about 30, maybe we may do quite a bit more than $30 billion worth of loan conditional commitments this year, although please don't quote me on that necessarily. I think that's where we're headed, which sort of puts us on par with the scale of what the World Bank will do in a year in terms of lending.
So, John, let's stick with you for a moment. So, these applications, characterize sort of the nominal application. I mean, how prepared are these companies? What do they sort of understand, and especially what don't they understand about what the role of the DOE LPO actually is?
Yeah, that's a great question. So I'm going to, again, because we have programs that also focus on mature companies that are building, for example, renewable projects, they will come to us and be much more prepared. But for the ones who come in through our innovative clean energy programs, where this is truly the first time anyone has done the thing, the biggest lesson, I would say, the biggest sort of wake-up moment for these entrepreneurs is realizing that how to pitch to debt, not equity. Because they come to us having gone to Breakthrough Energy Catalyst and Trellis and other venture shops, and they've been painting a picture of 10xing or 100xing and shooting the moon and changing the world. And we're like, that's great. Show me your cash flows. How are you going to what is your debt service coverage ratio? Do you make any money at all? Do you have any applied engineers? Who's your CFO? Right? Do you have
a pain, Jonah? Come on, those are the.
Well, as my boss, the director of the program, Jigar Shah, likes to say, when you pitch to equity, you paint the future. Yeah. Right? You paint a vision of the future. When you pitch to debt, we want to see all your dirty, all of the skeletons in your closet, dirty lawn, everything under the bed and in the closet. Right? We want to know your worst secrets because that's the thing that's going to tank the project and prevent us from getting paid back.
Yeah, I mean, I teach finance at HBS, so simply, it's right. Equity is like you're participating in the upside, so you want all the possibility, where debt's all about the things that can go wrong, which is a really important distinction, and will come when we talk to Mario, who's trying to sort of blend those two pieces. So Lee, you're out raising capital. So is the primary target a philanthropist, an investor who's okay generating less returns than they might otherwise, or someone who expects market returns? Talk about the investor base you're targeting. What's the pitch?
Yeah. I think there is a lot of different definitions floating around for some of the terms I'm going to use, but we're really focused on impact first funders. So folks that the greenhouse gas abatement potential is the number one driver for why they do what they do. So that is primarily philanthropists. There are, if you are familiar with program-related investments versus mission-related investments, we're really honing in on the PRI side of things.
Can you say, just let's go a level deeper on those, because I'm not sure everybody will understand like the distinction.
Yes, tax code. I'm here for the fun of the day. So PRIs are on the grant giving side of the house. They can actually contribute to the tax exempt status of a philanthropist for a private foundation, versus MRIs tend to be more on the endowment side, where the staff comes from a purely financial market rate return background, where the returns and longevity of the endowment is more of the mission than the impact that the investments are having. So we're focused on the former.
Got it. And success will look like when you raise the fund, you'll have a little bit of all those types of capitals and sort of a toolkit to choose from?
We are focused entirely on the former side. Okay. So we want to have a lot of flexibility in the solutions that we're bringing. And as a 501c3, as a public charity, we are entirely charitable in our focus in terms of the impact that we're driving, but we are able to still seek returns alongside that. We have 3 underwriting criteria that we look for when we're selecting companies. One is the greenhouse gas abatement potential and the ability to significantly mitigate CO2 and other greenhouse gases by 2050. The second is a bridge to somewhere. This isn't just a moonshot. There is a real company behind this idea. And the third is additionality, so that in the absence of our participation, not as much impact would be generated. Maybe it's the case they wouldn't raise as much money, or maybe they'd have to downsize the project. So that last piece is really a driving part of what we do.
Got it. Okay, thanks, Lee. Mario, back to you. So you have 120, probably closer to 130 hungry entrepreneurs looking for capital. So you're a popular guy in the BEV universe and outside. When you see these companies come and start talking to you, and you're a hardcore infrastructure investor, right? So similar question a little bit to Jonah, like what are you seeing that they don't understand yet about the conversation they're about to have with you? And what have you had to learn to sort of calibrate yourself to move more upstream in the capital stack?
Yeah, no, absolutely. So Jonah, like exactly, your point is exactly right. So 120, 30 companies at BV, but like there's a whole universe out there. We work with we're independent that we work with every other VC firm in the climate space. And there's hundreds, of companies asking us for money. Now, our fund is $1.5 billion between half grant and half equity. Not to get into, it might be your next question, but you would think that, we should have deployed it all already because everybody needs money, right?
That's what I'm hearing from the company.
Exactly, right? Like, give me money, give me money, give me money. I think where we find a failure, or not failure, but where we find the big gap, right, is the difference in how infrastructure investors see the world and how venture capitalists see the world, right? I think one of the biggest sort of gaps that we see is the fact that venture capitalists and, as investors have tried to apply a software model for growth and scale up to hard tech, right? And you and I have talked about that. But basically, I think 2 of the biggest sort of symptoms of this is having the founder sort of try to drive the company all the way through the cycle, where that might work, in Uber and Facebook, et cetera. But here, you have to evolve. The CEO has to evolve. Many times he has to be replaced because the person that got you from the lab to a pilot, to a demonstration project is not going to be the person who built the first $500 billion project if they don't adapt, right? So it's a very scientific, technology-driven innovation mindset where you now have to shift to a construction mindset, right? And I think the other thing is that path that I just laid out, the lab to pilot to demo to first of a kind, if you don't approach it the right way, if you don't think it's existential to your company, you're not going to, really spend the resources or hire the right people to be able to drive that. And I think the lack of skills, so one is applying a model of software to hard tech, and the other one is lack of skills in this world where we see a lot of companies have 10 people doing business development. They want the hockey stick, the shot to the moon, as Jonah said. But the reality is, unless you get your first demonstration project done, your company could die pretty easily because you have never proven the tech, right? I don't care what the lab and the scientists say, you have not proven tech in the eyes of the investors that are to come. So that's, we've learned now, however, though, to your second part of the question is we've learned a lot how to deal with this, how to deal with taking people in with their great ambitions and visions and say, hey, how do we settle you on a path that you can drive your first of a kind project, right? And I think that's been the biggest learning experience for us is you used to dealing with people with fact-based, reality-based, hey, these are the timeline, these are the permits, et cetera, and having to teach that to a whole bunch of CEOs and startups. That has been sort of the biggest heavy lift that we've had to do.
Got it. So I'm often asked about Clean Tech 1.0 for those of us that sort of lived through that in the aughts and up, where we had like a lot of capital crowd in to support some of these innovations. We start to have some scale, and then for several reasons, but primarily because of the mismatch between the expectations of capital, venture capital, and these companies, and the ability to scale, and there was no real mechanisms to help get us across this this bridge to bankability, which I think sounds better than the Grand Canyon of death. I'm going to train myself to
more
switch.
Positive.
It's more positive. I like that. So everything kind of came crashing down, right? And we're now at a place where we have the breadth of innovation, the creativity, and the passion of the entrepreneurship that's being done, and the urgency of the problem is much greater. But we still have that same challenge. We still got to get there, and that's what sort of keeps me awake at night. So, Jonah, with that backdrop, I don't want to bring up the S word, Solyndra, but how many folks are familiar with Solyndra, right? So still, it is amazing to me how much that sort of weighs on the consciousness. So as you're doing your work in DC and you're working around Capitol Hill, is Solyndra still a thing? And how do you manage the risks you're willing and need to take versus sort of the political dynamic of Washington?
Yeah, can I ask, how many of you are familiar with Tesla?
Yeah, there you go.
Utility scale solar?
Yeah.
So, I mean, if you actually look at the track record of the Loan Programs Office, and I think that the difference between, let me zoom all the way out, the difference between then and now is we have a 10-year track record, we have a 12-year track record of being very successful, shockingly, actually, if you look at the risk rating of our portfolio. In 2012, we would have expected to have about 13% losses. We've registered 3.2% losses over that period. We have, other than the subsidy we've put out, credit subsidy that was allocated to us by Congress, LPO has returned with interest a profit to the American people, like to the American taxpayer. Like we have been very successful stewards of taxpayer dollars.
Bravo!
To the point that the guidance that we get from Secretary Granholm, from John Podesta, from the White House in general is lean in. You guys got to lean more into risk, right? What are you do? Like, what are we doing if not leaning into risk? We need a reasonable prospect of repayment, but we also have to expect that some significant portion of the projects will fail because, and that is why we are here. And so, if you look at our track record, for 10 of the first utility-scale solar farms in the U.S., Tesla's first big manufacturing facility that they ever financed, the first new nuclear reactor that has been built in the United States in a generation, ribbon cutting 2 weeks ago at Vogtle in Georgia. This is the kind of thing that I think we are here to do, and I hope that we're in a position over the next 10, 20 years to do the same for this next generation of technologies because we have the track record to back it up.
And a quick political timing question. I think we have an election coming up in November, if I remember. How much of what you do matters as it relates to who's in the White House or who's in control in Congress?
So
I really do mean it as a sort of a factual
I know.
question.
It's a factual question. So I think policy continuity matters for a variety of reasons in the context of this whole agenda that's been put forward, which I think you could look at as the boldest climate ambition that's ever been set by an administration ever. And LPO is one, I'd say, quite important piece of this. It's just one piece of this. If you actually take apart the different components of Bill, IRA, CHIPS and Science, and you point blank ask folks across parties how they feel about it, generally speaking, there's an enormous amount of bipartisanship. I was at a talk not too long ago. A senator spoke, a Republican senator spoke about how, maybe the Inflation Reduction Act was passed in a partisan way, but it was created in a bipartisan way. And we like a lot of the stuff that's in there. And if you look at LPO's portfolio right now and the applications that are coming in, 2/3, 3/4 are in red and purple states. Like that's where these jobs are, a huge amount of these projects are being built. In very sunny, windy places with great access to infrastructure and a lot of people who are ready to roll up their sleeves and build. And so, look, I think from where we sit, I think if logic and reason win the day, and I think there's a lot of folks who want to see these projects be successful for American competitiveness and job creation and the role that we need to play in the world, I think we would hope that these things have real staying power in it, regardless of what happens in November.
Mario, when you're looking at projects, both with your infrastructure background, but in particular through the Catalyst aperture, how do you think about the current policy landscape, Inflation Reduction Act, regulatory certainty, uncertainty? How do you calibrate against that? And will you invest in regulatory tailwinds, or does it have to be a standalone project without any goodness from the policies?
No, I mean, look, as I said, we definitely want to drive, the green premium down, and we want to drive these projects or these technologies to profitability, right? So I think that's one thing. Obviously, we know that's not going to happen on day one. What's interesting is, as a global fund, we're able to see the differences in what's happening in Japan, what's happening in Europe, what's happening in the US. And right now, if you ask me, I'm far more positive on Europe because Europe has carrots and sticks, right? The regulation around maritime fuel, around SAF that has been enacted in Europe, it's really helping drive customers. And now industry, for example, decarbonization of industry is really helping drive customers to, ask for these products and pay a premium for these products, right? I think what's happening in the US, unfortunately, we've had a sort of mixed bag of, there are some things that are, the guidance is good, it's working, people are, such as thermal storage, that is something where people are like, hey, we should do it, we should invest. There are investors crowding into the sector. And then you have, hydrogen, where unfortunately the guidance that came out, Christmas Eve has been so detrimental to all these projects, right? It was guidance that was based on not necessarily academic work, not necessarily work on the ground that took into account how hard it is to build these projects, right? So I think it's a mixed bag here in the U.S., but I think the lack, again, back to the lack of project know-how and how hard it is to build these projects, has led to an enactment of policies that unfortunately that aren't going to push the hydrogen sector forward. And we're seeing it. There's a lot of big, large, small players dropping out and abandoning projects because they don't feel that the regulation will be there for them to be profitable.
So Lee, one of the driving, I think, principles of Prime and Trellis is this idea of additionality, right? So you talk about your theory of change as relates to if you do your work well, this crowding in of capital. What does that look like, and what sources of capital do you think that you can crowd in, and at what scale?
Yeah, and I think also bringing in the question of projects that have government support as well, there is a cost-sharing mechanism where you're not just funding these projects with government capital. You do have to find other investors, and sometimes the market signal of government support is still not sufficient to get the other investors in the door. So you're really seeing a layer cake of many different sources of capital here. I think it is regularly being pointed to, but H2 Green Steel recently announced their fundraise, and they had over 20 different investors in that, and I believe it took them years to piece that together. So right now it is taking a lot of relationship building and a lot of different actors to do that. So Trellis is really looking at projects more in the kind of $10 to $100 million range. There's going to be a wide spread of the cost of getting these first commercial projects done, but that's kind of the sweet spot for us. And we're looking at really working hand in hand with the other investors there. I think a lot of these frontier climate infrastructure funds have champions in the organizations right now who want to be supporting these novel technologies, but don't necessarily have buy-in from their investment committees. So it takes partnership and seeing more market movement to gain the excitement of the other partners and get a yes vote. So we're really excited to be partnering and field building in that way.
Jonah, talk a bit about the kind of U.S.-China or sort of the global geopolitical dynamic today, and as it relates to folks coming to you for a loan guarantee or a loan itself. Domestic content requirements, do they have to build in the U.S.? How do we think about then the U.S.'s role in being the sort of the home of innovation for the rest of the world? So just sort of frame that up for us.
Yeah, well, I went to a really interesting talk yesterday. I don't know if anyone was in the US-China discussion about sort of the importance of continued collaboration on things like innovation and how so much of the advances that we've seen across technologies, inclusive of clean energy, have come from joint US-China collaboration in the past. That said, I think when America has had a posture for the last 10, 20 years, which has sort of been, we're going to invent really cool stuff here. Once you've invented it, entrepreneurs, go build it somewhere else. And then come back here and sell it. And I think one of the things that has really shifted about this administration's policies has been, we not only want to invent things here, we also want to build things in America too. And one of the challenges has been when you actually look at where things are getting built in the battery supply chain and critical materials and in the solar supply chain, PV up and down, in the EV supply chain writ large, a lot of that is still concentrated in other countries and in China in particular. I think that said, when we look at the impact of what we're seeing from the IRA and from the infrastructure law, if you look at projections of what we'll see by 2025, I think Bloomberg New Energy Finance just put out in their recent annual investment outlook, is the proportion of investment in the world into, for example, the battery supply chain is going to go from basically everything in mainland China in 2023 to about a quarter of it in the US in 2025. It just takes a minute. It takes a couple of years for these types of investments to show up. It takes a little while for them to bake. One more point I would add, which is one of the big challenges that we face in the US of going from a world of invent here, build there to a world of invent here, build here, is a lot of the entrepreneurs who are looking to build in America, a lot of them are just that. They're entrepreneurs and innovators. A lot of the heft and incumbency is abroad. And for folks who've built things and really, it is not necessarily a technology problem, as Mario was saying, it's an applied engineering problem, right? This is, can you actually build a plant? Yep. And the Chinese are extraordinarily good at that. And it is in our DNA to be good at that too. And in a lot of sectors, we are very good at that here in the US, but I think that is a skill that we are rebuilding. And so finding the right balance of both building these industries here in the United States while weaning ourselves off of decades of dependency abroad, it's just a balance that we're having to strike almost project by project at the Department of Energy.
Mara, we tend to say first of a kind project. I mean, we're talking about sort of projects that produce things. We also talk about first of a kind factories and such. How do you think about, are those more similar than different? And then with breakthrough, you don't really have border limitations because it's a global enterprise. So how do you think about the global landscape of where people should be building projects, where they should be building factories, border adjustments for carbon? How do you think about all those pieces? It's a big question. Sorry.
I was going to say,
whoa. Sorry, I've got on a roll there.
I wasn't ready for that.
Yeah.
Give me some coffee first. No, look, first of all, we don't see a distinction, right? Yeah. Whether, we're backing projects that are being built, that are producing a commodity off of them. We're backing factories that is, their first time building something, product is going to come out. And what we see is a lot of that product could be, for example, in the lithium ion space, et cetera, could be contracted, long-term contracted, right? Notwithstanding the price of lithium now. But anyway, and then there's something in the middle where we can do a project where a lot of the product coming out of a factory goes into the project. Therefore, by supporting a project, we are, indirectly supporting the standing up of the first factory, right? How we see it is, I always tell people, construction is extremely hard. The three directors in the team and myself have built billions of dollars of infrastructure. Even doing a bathroom renovation in your house is just something always goes wrong, and construction is so hard. So what I always tell people is building your backyard. So I do think that the demo or the first of a kind should be in the backyard where you can control it. Now, where you go to optimize this, right now we're backing for example, a thermal battery solution applied in 3 different countries in Europe. that the product comes from Southeast Asia, right? So I do think globalization will eventually start to sort of shape in this world, but unless you can build it in your backyard first and actually prove it, it isn't going to happen that you have a global sort of business or you have a global supply chain.
Got it. Lee, I know you have a passion for resilience and adaptation. We've sort of implied, I think, in this conversation, a lot of times we're talking about climate investment, innovation as mitigation levers that we're pulling. So how should we think differently if we're thinking about adaptation and resilience, which is, I think, arguably much newer for us to understand the solutions and how to underwrite those. But how would you think about that?
In terms of identifying the solutions or in terms of companies that are driving them?
More identifying, and is the underwriting process for you would be different than a mitigation-oriented solution?
Yeah. Big question. I'm going to need some of that coffee too.
Yeah.
Okay. Have you? Are you seeing mitigation or adaptation solutions starting to think about this type of financing? Are they getting to that scale, or are we still a few years away from that point?
Yeah, we aren't saying as much at this point.
Yeah.
I think within the blended finance space, you see development finance institutions, you see IFC working on roads and wind farms and solar projects and emerging and developing economies, but just starting to dip their toes more onto the adaptation side of things.
Yeah.
So I think we've seen some inspiring ideas today and yesterday on that front, but in terms of getting these big financing mechanisms for it, there are kind of a few initial examples at this point, but far from standardization. Yeah.
Certainly at Breakthrough, we've been operating against 5 big challenge areas that are all mitigation, and probably 18 months ago, we added adaptation. I think we're still struggling to figure out, like, what are the outcomes? How do you invest in that? Is it really technology? Jonah, are you seeing anything in the world of adaptation resilience coming in the front door?
So we at the Loan Programs Office, that's not part of our core mandate, other than what I will say is, in the context of our loans to utilities, who under one of our other programs, which is our Energy Infrastructure Reinvestment Program, that program specifically is designed to replace and reinvest in existing energy infrastructure to make it cleaner, and to position these utilities and other operators for a more modern grid, right? That we're going to need to connect all this new generation coming online. What we're seeing there is the extraordinary cost of climate change in the form of needing to underground, hundreds of miles of transmission lines or harden, energy assets that previously were totally safe and secure, but now because of wildfire risk or hurricanes and floods and all sorts of climate disasters, which are increasing significantly, these utilities are now having to spend a staggering amount of money, which, by the way, they're passing on to ratepayers, based on where folks live in the context of a warming world. So that is the place we're seeing it. I would say for innovators in this space, the other hat, so I finished a detail recently with the White House Office of Science and Technology Policy and headed up their clean energy programs, and resiliency and adaptation was a core focus of that office. And it is challenging. I think the business models that underpin adaptation and resilience are just, they're few and far between, at least that we've seen. Like there is a business case for mitigation in many, many instances. I don't know if others are seeing this, but that's one of the things that we observed.
No, I wanted to jump in here because when you think about sort of that adaptation, is who's going to pay for it, right? And how are you going to pay for it? Like if you think how toll roads were built, most places in the world is, a government would say, hey, if you build this toll road, you could put tolls on it, or if it's available, I'll pay for it, right? Like by the mile, by the car, whatever, right? How do you do that when you're doing a levee? How do you do that? Is it, however many gallons didn't come over the levee or the pier or whatever, if you think about Miami, right? It's so hard to build a business model for adaptation. And we've talked about it in the team a lot, and we can't even begin to figure out how you would even price it and structure it in a way that someone can invest in it. So,
interesting. My friend and colleague John McComber right there from HBS spends a lot of time in that sector. I know other folks around. It's a lot to do. I think it's a really important area for understand the solutions, how to structure them, how to finance them, and then also we were talking earlier at lunch about how do you get people to start to believe that adaptation is required and it's not quitting. It's not quitting on mitigation. It's sort of yes and. So before we come to you all for questions, I want to go down the line, sort of like a quick example of a project that you think is an exemplar of this working.
Yeah.
You can name it or unname it, but
No, I name it.
define it.
So we publicly committed to Infinium. Infinium is an e-fuels company that is, building their first of a kind project called Roadrunner in West Texas. They have done, we think, pretty much the right things, right? They have done a demonstration project, 10 megawatt electrolyzer that is now, cranking out e-fuels. It is the largest and first in North America, right? 10 megawatts, when you think about the billions, the gigawatts that have been announced, the biggest thing right now in North America is 10 megawatts, right? They're doing it. They built a really large and strong team around it to not only build it, but operate it. On the back of that, they're now going to the first plant, which is 70 megawatts. And now, a year ago, when we came and we started working with them in structuring that sort of first of a kind project, no investor really wanted to look at it. And now they have large infrastructure investors interested in it because things have been shaped in a way, and they've listened to our advice and they've sort of done a lot of work in a way that, hey, how do we make this replicable, right? And how do we make it attractive to infrastructure investors? So, knock on wood, we're not sort of there yet. We haven't broken ground on that, but, all signs point towards the fact that this could be a success story. And by the way, they did their business case based on the worst case scenario on 45V, which is why today it works, because they weren't surprised by the guidance that came out.
That's good, thank you. Lee?
Yeah, so I'm going to give an example of the incredible perseverance of the companies here. So it's going to start as maybe a downside case, but then it's going to
in
come back.
disguise. I love that.
But there's a green ammonia company that wanted to raise funding at the project level for their first commercial project. They just weren't able to do it, and their top co-raise couldn't support a project the initial size that they wanted. They ended up downsizing to less than half of the size they initially wanted to go for, and got it done. And now they're collecting data from that project, and they're able to go out and start fundraising for the next project with real world data. So these things rarely go as folks want to, but starting conversations very early with banks, with your EPCs, with potential investors gives you a sense for how you need to stage these things, and then kind of rolling with the punches from there.
Thanks, Lee. Jonah?
I love the perseverance theme, so I'm going to stick with it. This is a real perseverance. This was a mixed story. So the story of Vogtle, which I mentioned at the beginning, which is the 2 units that just came online, each a 1.15 gigawatts. This is a 12-year journey with our office financing the first new nuclear reactors built in America in 25 years. Happened to bankrupt Westinghouse along the way, right? Went 2.5x over budget, 2x over time. I think until these came online, I think, this was a very challenging project to pull off. Vogtle, with all 4 units now online, is the largest source of clean energy in America. We have, through the course of this project, trained 12,000 pipe fitters, engineers, and electricians who are now certified nuclear grade. And over the course of 10 years, so not only trained them, and in many cases also trained their next of kin, this has transformed whole families. Like, they've grown up at these facilities. And when we think about this next generation of amazing nuclear technologies that America is moving out on, small modular reactors, microreactors, and big traditional reactors like this, if we hadn't persevered, we would be starting from 1992.
Yeah.
But as it is, we're starting from 2 weeks ago. And I think that's a much better place to start. Love that. And there's so many other frictions. Workforce is a huge one. We start digging into this, but there's many other frictions beyond just the capital markets and the capital stack itself that are in the way that we've got to address both, domestically and globally. So welcome your questions. Hopefully make them a question and an answer, not a statement and an answer, and then introduce yourself. How about you start right there in the blue jacket?
Hi, Jasper Camacho from Bechtel, and happy to be my colleagues be part of Vogtle and a lot of your companies. My question is, where does corporates play a part of getting the first of a kind move into commercial scale? How do you partner? How do you think about partnering with them? What do they offer in this endeavor?
Great question. Maybe Mario,
Sure.
it's embedded in the strategy.
Absolutely. I think corporates have a very large role. I think corporates are the ones that can support green premium through commercial contracts. So one of our LPs, American Airlines, actually signed the first 10-year SAF offtake agreement that was ever signed around the world. Paying a premium, obviously, but as you know, aviation buys fuel in a 3 to 12 month basis. They went 10 years, right? So it took a stretch, but I think corporates that are forward leaning can make a huge difference in making these projects happen through commercial purchasing of these products.
Could I add to that? Because I think so. There's corporates as off-takers. There's also corporates as strategic investors on the equity side, and I think in both cases, enormously valuable. I think even sitting in the Department of Energy as a loan provider or as a grant maker, for those of us who've sat on funding opportunities, we look for whether or not you have credit-worthy offtake or you have someone who's putting equity behind this deal who actually, I don't want to say knows what they're doing, but has a track record for being involved. And we look for which EPCs are they partnered with, because that sends a message that, oh, you actually can take on an applied engineering problem. Oh, the offtake is going to be there 10 years from now, right? This is not some flash in the pan. And I think if we go back to some of the challenges that these technologies face, especially for ones in nascent, like syn fuels, for example, nascent industries where the off-takers also new, and your company's new, and then the feedstock provider is also brand new. And you're sort of, any piece of this that breaks, it breaks the whole thing. The more you have someone who's been there, done that in different pieces of the puzzle, it helps to stand up the whole thing.
Lee, can I ask you, as you're talking to investors, do they have a point of view of the purist, which is we've got to divest and it's got to be pure green, or how do you educate them about the importance of strategics and bringing them along through the life cycle of these companies, especially those projects?
Yeah. So on the infrastructure side, for the folks that are kind of coming a little earlier to get these projects done, or at least considering them, they see a lot of opportunities in a given year, and sometimes they don't give them much time unless they see a corporate that is involved in some way. They want to see someone on the cap table who has been involved in something similar, who can lend more than money, who can lend knowledge. And so it is fundamentally critical to attracting investors to these deals.
It was so key. I think we're going to scale all this. Yes, right here in the front.
Hi, my name is Madalena Pruna. I'm an ex-investor with IFC in emerging markets in electric mobility. I have a question for Jonah and the trucking sector in the U.S. So you're talking about credit-worthy off-takers, right, for trucking. How about guarantees? Have you thought about guarantees for the trucking sector for EVs, right, for trucks? That's one thing. And then for Mario and maybe for Lee as well, I have a question.
Can we focus on question one?
Yeah.
Sure.
For a moment, thank you, and then we're going to pass the mic.
And can I ask just to clarify, do you mean like a loan guarantee, or do you mean a... So within our Innovative Climate program, our 1703 program, we can finance the decarbonization of heavy-duty vehicles. And in addition, following the passage of the bipartisan infrastructure law, that gave us new authorities, which were then received appropriation under the Inflation Reduction Act for our advanced technology vehicle manufacturing program. It was expanded from just passenger and light duty vehicles. This is manufacturing component inputs into those markets. It now includes medium and heavy duty vehicles. So we can finance the manufacture of inputs into the medium and heavy duty vehicles market. And so this is an area we absolutely expect to be spending quite a bit of time. It's still, as you know, sort of relatively early stage compared to passenger and light duty vehicle, but especially as we see more corporates on the fleet side get involved, both from an offtake standpoint and an operator standpoint, I think we could see some pretty big projects come our way.
Okay. Yeah, actually, come one row up.
Thanks. This is a question for Mario, but I would love to hear from the other panelists as well. So when you're thinking about incentivizing infrastructure investors, how do you think about the time it actually takes to kind of scale these investments up and then ultimately exit them? Oftentimes, infrastructure funds have a finite life or they're looking for cash yield. So I'm curious how you've kind of found that balance. And for context, I work for BlackRock's Climate Infrastructure Fund, about $11 billion of AUM. So I think theoretically the type of investor you guys would be targeting in the long term.
Yeah. So look, I think the archetype that we're shooting for in a lot of these technologies is platforms, right? We saw the fact that at the beginning, infrastructure investors, Canadian pension funds, et cetera, would never try to go and buy projects, renewable projects. I'm talking about solar, wind, right? As these things grew up and they started to amass volume, size, and different projects and diversify that single project risk, those pension funds started to come in, right, and invested heavily in these platforms. And that's why we have major platforms today. If you apply the same archetype to this, the faster we can get technologies, off the ground by doing the first of a kind, the demo first of a kind, and then, after that, it becomes really, I wouldn't say really easy, but very feasible to think of a world where this becomes platforms, right? Where the thermal storage developer or the XYZ technology, you can start replicating it across the US or around the world. So I think that is going to be the way, as you don't get out of bed for less than $500 million. You can't, that doesn't work for a $20, $30 million project, but you have 100 of them, it does work, right? So the ability for that team to scale up really quickly and be able to drive that volume, I think that is going to be key to getting people there, such as yourselves. Yeah.
I'm Steve Powell, Managing Director of Sino Powell Capital. We're a boutique investment bank, and we specialize in financing energy projects. My question is going to be for you, Jonah, but first, I took finance at HBS long before you were there, so that should make you feel a little younger,
Hope
perhaps.
the math is the same, yes.
When a project gets financing, if it's debt financing, they do their standard underwriting. If it's an equity investor, they look at a return in a reasonable amount of time. In your case, some of the projects you do not undergo those standard underwriting procedures, as far as I can tell. It's not necessarily the marketplace that's making those decisions. These are policy decisions. If you want to bring a company back from China, maybe it's not the standard underwriting decisions that somebody else would make. If that's the case, who makes those decisions?
So LPO is fundamental. I mean, we were stood up following the Energy Act of 2005, and the rules that govern our programs, obviously we have several different programs, but generally speaking, they all subscribe to basically 4 different tenets. One is the project has to be built in America. Number 2, generally speaking, it has to reduce greenhouse gas emissions. Number 3, there has to be a reasonable prospect of repayment. And then number 4 is a bit of a grab bag. So it's either innovative or it's reinvesting in existing clean energy infrastructure. I think what you're describing is how do we define what a reasonable prospect of repayment is. I think in general, every single one of our projects goes through a very rigorous due diligence process. It can take 3 to 6 months. We've got our entire underwriting staff, for the most part, has come from a mix of private sector and structured banking backgrounds, or Exim Bank and other parts of the government that are deeply, IFC, who are deeply steeped in this. And while we will take on more risk potentially than a typical bank, I think the thing that sets us apart from an underwriting standpoint is that if you are eligible for our debt, we will provide it to you. We don't have a profit motive that says, we're only going to do this if we can do 100 of them. We will do it if we can do 1 of them. And we will get out of bed to make that happen in ways that the private sector today will not. Now, I think you could say that we're a policy banking in the sense that we were enacted by policy, but we respond to the projects that come in our door, and that's the nature of how we operate.
Thank you. Emily?
Thank you very much for the terrific panel. My question is around demand aggregation and coalitions. We talked about offtake agreements earlier. And my question is, there's been more attention with Frontier, for example, in climate tech. And then recently, the Google, Microsoft, Nucor coalition for clean energy, nuclear, so on and so forth. What is your sense of the role of these aggregated corporate off-takers, and how do you think about that in the mix of funding and risk? And I'm Emily Chen. Thank you.
Want to tackle that either directly or conceptually?
Are you looking at me or are you looking at Lee? Or
I've been talking too much, so I'll.
no, Lee.
Yeah, okay.
Please.
Yeah, I mean, I think it's some interesting examples in there, particularly within the airline industry is an example where the off-takers aren't creditworthy. So sometimes having a 10-year commitment alone is not enough to get an investor across the finish line. So particularly with the volatility we've been seeing in the voluntary carbon markets over the last year, I think some of these initiatives are fundamental to getting projects built. And you'll see instances where the folks coming together for the offtake agreements are also investing in the project. So they're kind of pulling multiple strings to get these things done. So it is one of many different solutions being pushed at once to try and address green premiums, try and help get these things scaled and get them down the cost curve. They alone aren't going to do it, but there's certainly a useful tool in the toolbox.
One thing that's interesting is you haven't really heard yet a lot about doing things at utility scale on the grid, right? So if you were in the Ernie Moniz conversation earlier, if you live in the world of the grid as I do, realize how hard that is. So I do think that these corporate bilaterals or these syndicated bilaterals are so important. I mean, almost all the examples that we've heard have been corporate offtakes, corporates partnering with innovation. So I think more of that is going to be better, and then we can get that at a multinational level as well. So for those of folks who are from a corporation, you have enormous ability to move the dial as a buyer, as an offtaker. Anything else on that before we go to in the back left, please?
Hi, I'm Akriti. I'm a regulatory researcher with NREL, and I'm focused on energy justice. So my question, I think, in keeping along with the closing theme about workforce adaptation, I'm wondering, especially for the two finance folks on this panel, when you are soliciting projects or when applicants are applying, is there room in your company's profit bottom line to require those applicants to have a bucket of money that is focused on retraining the workforce, or like you said, in your neighborhood, retraining the construction workers in those areas? Or do your companies have buckets of money that can do pro bono retraining of workforces?
I'll take that one.
Yeah, please, thank you.
By the way, Jonah is a finance guy too. Just everything he said. I know. I'm kidding. I'm just teasing. Look, the market. We feel the market's going to take care of this problem because, guess what? When Infinium built their 10 megawatt demo in Corpus Christi, Texas, there is no hydrogen expert to be spoken of in the United States, right? The 35 people they have there are all ex-oil workers that they had to retrain in order to stand up, design, engineer, construct, and operate this plant, right? They're gonna have to do that now to the tune of like 50, 60 people for that, and for the next facility, and their next facility is $1.5 billion, right? Think about the amount of labor, 2,000 people, probably peak construction time, that they're gonna need in order to do this. So, we do track how many jobs are created because of this. And again, those jobs are new jobs because they never existed before, because again, no one's ever built and operated these technologies before. So I do think that it is happening by the fact that we stand up these projects. And that gives me great hope that, again, you could train a bunch of oil workers, you could train a bunch of, solar workers into brand new technologies that have never been done before.
Could I jump in on
Please.
that? I would also just note that there is much more to community engagement than jobs. If you look at Lake Charles in Louisiana, for example, not much of the community there is engaged in the industrial activities that pollute their environment. And so I think if you talk to folks there, they get a little tired of hearing that they're going to get jobs out of new construction there, because a lot of them won't. They'll just get the downside of it. So I also think it's incredibly important for some of the community engagement work that we're starting to see required to go along with this funding. to make sure that the fence line community has the opportunity to provide meaningful feedback that is incorporated into the planning and construction of the projects.
Jonah, please, I'll make one comment, then we'll take the final question. Go ahead.
Okay, so just to build on that, and I think to Lee's point, so we made a decision at the Loan Programs Office to require community benefits plans for every loan recipient, and we did that. You can argue it's the right thing to do. You can also argue that it's good business because it de-risks. These are projects that are going to be in the community for 10, 20 years, and one of the things that we found in working with applicants to go through the process of developing these plans is there are dots to connect, right? They are focused on something extremely hard, right? Which is commercializing a first-of-a-kind technology. Their first thought may not be, what is my local building trade union, and have they already been training up a workforce around this type of project that could be really useful and drop in and support building this out? That is a role that we often play in making those encouragements. Or have you talked to a local community college about establishing a program where you can hire people directly over the course of the construction of this project? And so I agree, it's not just about jobs, but it's also about like, what is the role that this investment is going to make in the community? And have you been thoughtful about all of the different ways that you're gonna participate?
I mean, take two other comments would be, one, we've been talking about federal money and interesting project finance money, but another driver for a lot of these companies to go certain places and build things is state and local granting money. So that drives, there's an absolute economic development lever there, as you know, that gets pulled in. And then through the permitting process, the engagement with the indigenous communities, or in Canada, the First Nations, becomes a really important convening and discussion mechanism, and making sure that we're thinking about the environmental and economic justice there as well. So final question, hope we make it very pithy, and then we're going to wrap up.
We talked a lot about corporate investment, but New York is trying to do something different. They just passed a public power bill. So what do you think about like public financing, with the ratepayers that are taking the risk to finance these projects, and maybe first-of-kind projects too? What do you think about that model?
Anybody having direct experience, Lee?
Could you provide a little more detail on the program?
It's just the public utility which New York owns is going to be basically working with EPC developers to build the projects.
Yep.
It's the ratepayer money which will be at risk for investing in these projects, not like any other company or private developers or anything.
No, I mean, that's already been tried and proven that they could just offer a PPA, or they could just offer a build, operate and transfer. I'm not familiar with the details on that, but it sounds like reinventing a wheel that's already been invented and it's tried and true. So I'm not sure. Again, I don't have details, but I think the models are there. In Germany, I mean, the first few offshore wind farms were stood up by government auctions, right? So I'm not, yeah.
I was going to add one other great program that New York is kind of pushing the bounds on innovation within what state policy is doing, and they're actually putting capacity payments in place to enable more battery storage on the grid. So there's a lot of great innovation coming out of the state.
Yeah, and I would just say, as the federal government, we as a rule don't comment on state government policy. But I will, what I will say is, I think one of the extraordinary things about how this whole American system works is we do have these states who are sort of pushing the boundaries in different ways to innovate, and we have the advantage of watching it from DC and sort of learning what works and what doesn't. And so I would say, without being as deep on this program, I am very excited to see what different states and localities cook up, because that's where the best innovation is going to happen.
Yeah, there's a lot happening in the domain. So we have just a couple of minutes left. I'm going to kind of run down the line. So I give you each a magic wand that you can wave and fix one thing that's going to make the bridge to bankability longer, wider, safer, lit, multi-lane. It's going to be huge. Lee, do you have yours already?
I do, but it's so unlikely in the U.S. in the near term.
That's okay. It's a magic wand. It's like unbelievably powerful.
Carbon tax.
If we go and ask it.
In the absence of that, though, I think as we get more data in this space, that's going to be incredibly helpful to get more projects done. The more data you have, the easier it is to get insurance in the space. But carbon tax more.
This border adjustment mechanism, is that like a mini magic wand? Does that make you happy?
It's specific to certain industries, and so it's not enough to get the green premium down on some of the industries yet. But
I'll go. Mine won't get clapping or anything, but I would.
You don't know yet. Don't
It's not. No, I prejudge because it's boring, not as sexy as carbon tax. But no, I would put 10, engineers, constructor, developers into every tech startup. Like if I could drop in a team of 10 people that are willing to work on individual startups, I would. Magic One, I think that would move the sector along so fast. But yeah, these companies have a very hard time hiring out of the next eras of the world. Nobody wants to join a startup. So.
Yeah, this workforce talent education. I know you're spending a lot of time upstream to educate the team so they're ready when they come to ask for money. So awesome, I love that.
As I said, no claps.
Oh, you go. Go ahead.
Okay.
Thank you.
We're doing full magic wand. So
Full
I would
magic.
say I would love to see incumbents come to the table with the same level of ambition and verve as the entrepreneurs and innovators that we're seeing, starting with utilities.
Nice. All right. So much fun. That was a fast hour. So at the beginning, I said hopefully 3 things you learned. Number 1 is where are we in this innovation to deployment? Because there's a lot of examples, a lot happening, a lot yet to figure out. But the cool thing is that we have just 3 examples, but there are many more of people and organizations that are figuring this out. And this is not sort of a silver bullet that's going to solve everything. It's every single situation is different. If you're entrepreneuring, be prepared earlier. If you're investing, move upstream, collaborate, figure out what happens. If you're a policy person, figure out what levers are going to actually make it work. If you're a researcher, we've given you lots of things to research. And so we've got to break the back of this. And I think that we will. I'm really optimistic, even more so than an hour ago. So I really appreciate all the great work you 3 are doing. Appreciate all of you joining us on a beautiful day. And they'll be around afterwards. We can follow up if you have additional questions. But have a great rest of your event. Thank you.
Thank you.